Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Chris Englebert, Founding Partner and Chief Investment Officer with Englebert Financial Advisors, to discuss how RIAs are helping clients navigate inflation. Chris, it is great to see you as always. Welcome back to Trade Talks. But before we get into RIA client management, what are retail investors most focused on?
Well, they're focused on two things, Jill. One theme that we have right now is what I call Revenge Vacation 2.0. So last summer, everybody wanted to go on vacation, but a lot of the resorts, a lot of places weren't open, so they escaped to maybe some local venues. Well, we are seeing clients go full blown this year. Travel is back. They're hopping on planes. They're going to, destinations, but that, dovetails into what we're talking about as far as inflation goes. I mean, plane tickets are double. We all know what fuel prices are. So, clients are really worried. They want to get their vacation in, which they're going to do, but they're worried about the effects of inflation on vacation. And so they're being a lot more astute and really trying to be more value conscious as far as the experience go, but they're going on vacation no matter what.
Yeah, I mean, think about it, whether it's gas, whether it's an airline ticket, then you have to get to said destination, and that means food, and everything is more expensive. There's demand to travel, so, hotel costs are going to go up as well. But I guess the question is, how are RIAs helping clients navigate inflation? There are day-to-day concerns, and then when you think longer term with their portfolios, especially with the market activity we've seen as of late, if purchasing power is decreasing and many of them are retirees, how are you helping them get through this?
Well, one of the things we're doing is we're really looking at everybody's portfolio closely, and I'm really trying to get people to understand, one of the big pitch the last year has been, you should have commodities as part of your portfolio, which we agree with, but I'm very concerned this summer about clients or investors chasing the commodity trade. In a former lifetime, I used to trade commodities, and I've seen these parabolic markets with regards to oil and agriculture. And I'm just worried that I don't believe it's late to the commodity trade as far as an overall structural longer term trade, but I'm worried about the near term volatility where you could literally, and we're going to talk about it in our next segment, have the price of oil come down, $30, $40 a barrel. You could have a situation where, we think that the agricultural markets, could have a setback. I mean, this is the second year in a row that we've seen peak agricultural prices going into planting season, which is highly unusual. Now, there's always a chance of a 10 or 15% probability of a drought, but if you don't have that drought, you could literally get, a lot of crops planted and a robust, planting season, which brings agricultural prices down, which actually obviously would help inflation in the back half of the year.
Challenges, we've got some pretty significant fire damage in the West Coast and in the plains, which of course we know, and the plains is a big part of our agricultural production. But to your point, we had a commodities trader who traded at the same time that you did on the exchange, and she shared some of the concerns as well. And I think that also trickles into the equity markets. And we're going to take a look at your charts now, starting with the S&P, because Chris, at some point, you have to start asking yourself, is it a bottom? If we get a rally, is it a bear market rally? Do valuations look really attractive here, whether you want to pick up shares or M&A activity picks up? We are at such a key inflection point with all these variables. So I want to take a look at your first chart, the S&P, and tell us what you're seeing there.
Yeah, Jill, you made some very good points. We agree with you. And what's been happening is obviously been very brutal. We've had a steady sell-off. But last week, one of our risk indicators flipped over to be more positive on the equity market. On Tuesday, one of our risk indicators, a better longer-term indicator, flipped over again. So our risk indicators are getting very, very compressed right now. And you could literally have a 10, 15% rally at any point in time. I know it sounds far-fetched because we almost had the S&P 500 touch bear market territory, which is a 20% decline, and see a sharp rally off of that. I can make the case that before the end of the year, you could actually see the S&P go green for the year, which obviously everybody's not thinking about at this particular time.
How about the Nasdaq? Led the way through the pandemic volatility. But in all truth, though, Chris, a number of these valuations had to come back and check.
Yeah, and that's what we're seeing right now. I mean, you're getting major tech companies whose valuations are at the same level that they were in 2020, but yet sales are up, revenue are up, they're doing extremely well. But I think a lot of the volatility, and we obviously watch all the markets in the cryptocurrency markets the last couple of weeks bled over to other risk assets. And people are beginning to realize that, well, maybe the cryptocurrencies are just high beta, a tech trade. And so when the cryptocurrency sold off, we saw the tech stocks sell off. But again, the valuation levels are getting very, very attractive, especially for those companies, those tech companies that have a revenue stream that's, very strong and should be strong in the future.
Moving along to the Russell 2000, and Chris, you and I, it will be 5 years in August that we've been doing this together. And I feel like we keep saying still getting no interest from investors.
Yeah. And again, I mean, this is one of our themes. We talked about it last month. One of our themes is we think we're going back to the 1980s. And in the 1980s, you had high energy prices, high inflation, high interest rates. And one of the asset classes that did extremely well was small mid-cap stocks. I still am pounding the table on that area. Again, if you're looking at risk assets out there, this is from a valuation level, one of the cheapest areas we see. But again, it has sold off like the other equity indices so far this year. But I really think investors have to look at it. I got a note from a portfolio manager about the biotech area and how they literally had 86 companies in the biotech indexes that are trading below the cash on their balance sheet. So the incredible negativity that's out there, we think is going to provide some opportunities sooner rather than later.
In oil, you had said before, it wouldn't surprise you to see, a $30, $40 move potentially to the downside, but how long would that last?
Yeah, I mean, the question is, the bull story on oil is that the China reopening could spike oil prices once again, but we're taking the other side of the trade and saying that there's about a $25 to $30 war premium out there in the price of oil. And it's something that we really haven't had or experienced. And any kind of, ceasefire in Ukraine or something like that, those headlines, you could see oil prices collapse rather rapidly. And again, that's going to give some relief from the inflation measurements that are out there.
Right. And I'm glad you brought that up because we're going to wrap here with the 10-year Treasury. And of course, that is so exposed to what the Fed does. But the Fed can only control rates. It can't control supply chain issues. It can't control, unless it gets supply demand back in balance, but that's a very tough job to do, as we can see. They can't control the war in Ukraine. So any one of those headlines, to your point, has to actually happen in order for inflation to get under control. I think that would be more of a catalyst than just raising rates.
Yeah, exactly. And my view on the 10-year Treasury, we do a lot of work with volatility. And, one of the things I've said for a long time is that changes in volatility signify changes in market direction. We have just gone through one of the most volatile periods in the fixed income market, literally in history. You had, the 10-year Treasury have a rocket rise from 1.25% to 3% this year. I'm making the case to clients right now, there's a lot of value out there in the longer end of the curve, but I can also make the case that the 10-year pegged around 3%, maybe plus or minus, 0.25%, doesn't really do too much the rest of the year. And I can make the case it might not do too much into next year as well, because we've had such a huge rise and a lot of volatility in interest rates.
And Chris, actually, before we wrap, I want to go back to client management for a second. How do you manage client emotions when they are either nearing retirement or in retirement? We were talking about this. I think you had a webinar a couple of months ago about teachers nearing retirement. How do you not handhold, but get them through when they've seen their capital depreciate and they do rely on income, whether it's dividends or other products that you have within their portfolios? How do you get them through moments such as this? Are they afraid to get back into the market? Are they reminded of 2008, 2009?
Yeah, well, the first thing we do is we make sure we're talking about what's your time frame. So one of the things that we tell anybody that's retiring in 6 to 9 months is I don't care how bullish I am on the stock market. If you have 6 months, and we did this back in December with a lot of the teachers that we are having that are retiring literally in June, we said, move your 403B to 100% cash. I don't care what happens. I just got to get you out the door. But, if you're 2, 3, 4 years from retirement, make sure you're dialing down the risk in your portfolio. If you've got 5, 6, 7, 8, 9, 10 years, you're going to go through another bear market, another bull market before you get to retirement. But, again, it's kind of pulling back and making sure people have the right time frame as far as when they retire. If somebody has a super aggressive portfolio and they're leaving in June, well, obviously that's a disaster because that portfolio could be down 20%. But again, like I said, what we really do is we talk about that time frame. And, I've learned this a long time ago. The closer you are to the door, get your, risk assets, really pulled back, even if you don't make anything. I mean, this even goes to college funds. One of the other things that we tell parents to do is make a date that you, on your child's birthday, that you have 1 year on their 17th birthday, and move all their 529 plans to cash inside the 529 plan, because you're paying for college in 1 year. And that's what we've done. We did that with a lot of people back in the fall, and obviously it's working out right now.
I'm going to keep you a little bit longer here. Advice for younger financial advisors. This is not your first rodeo in prolonged volatility. These are the times that you need to be on the phone or emailing or proactively reaching out to your clients. It's very easy when the market's up, the portfolios are up, 20, 30%. That's the easy time to make the calls. What's your advice when you have to make challenging calls such as this?
You got to be honest with these people. You got to, spell it out. You got to say, hey, this year's been a brutal year. You're down. You've lost money. It's not fun. People know that. I mean, they watch the news and everything, and they know how bad it is. And some of them will say, I don't even want to open my statement or get online and do it. But you got to keep talking to your clients. I had a interview yesterday with a prospective client, which they're going to become clients, because they said the number one reason they were coming with us is that their other advisor hadn't talked to them in a year. I can't believe that still goes on in this day and age, but that's why they called me up. They knew me and the work that I've done, and they're like, we're coming with you because we know you're going to take care of us. And again, it's hard conversations. I mean, I have my own money invested in the market, and obviously, I've seen my assets decline too. But, we know that bear markets are followed by bull markets. At some point in the future, things are going to turn around and get better. We just have to make sure that we keep people talking and have communication.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.